All right, so let's pick up on this one of the last steps. It's not the last step. Recording adjusting entries to post to the ledger accounts. Okay. I have heard over the years that adjusting entries might be the one thing that a lot of employers are telling us that students coming in or fresh out of college grads are coming in and they're having a hard time with adjusting entries. They really are because they're all so different and you can't just really memorize it like you can that closing process. Remember, I told you that closing process is the same every single time. Adjusting entries are not. No two business is going to have the exact same adjusting entries. Okay, so it takes a lot of really critical thinking skills to really understand the adjusting entries. Okay, so let's come over here and let's talk about prepayments. This is where we get the cash before we have an expense or before we have revenue. Okay, so we paid for something and then we got cash for services before we actually perform the service. Okay, accruals are the opposite. Okay, we are going to accrue an expense and then pay it later. Here, we're going to accrue a receivable and get the cash later. Okay, there's a lot of things that are just estimates. Remember, when it comes to depreciation expense, there's all those variables of how long do you think it'll last? What's your salvage value going to be? Okay, all of those things go into, and they are estimates. They are not perfect numbers. They are estimates based on past experience, but they're better than nothing. Okay. Bad debt expense, that's the amount of the accounts receivables that we won't collect. Re remember that both of these actually has a contra asset with it. So your depreciation, that contra is accumulated depreciation. I'm just going to say equipment. And then that bad debt, remember that's contra to the accounts receivable. So that's allowance for bad debts. Okay. So they're both contra assets. I'm sorry, they are contra assets. They do not have a debit balance. They have a normal credit balance, contra asset. All right. When we have prepaids, we've paid that cash up front, and they kind of go through how you are going to debit an expense and credit an asset and how that affects those financial statements. Okay. So the first adjustment we're going to do is supplies. Before I just give you all of that, let's look at this. So they said the Dress Right Corporation purchased $2,000 of supplies in July. Anytime you are doing a supplies adjusting entry, draw the T account out. Do it every single time because supplies will they really love to twist the words and then you don't really know what you're doing. Draw a T account out when it comes to supplies every single time. Okay. So when we purchased those supplies, we debited supplies, the asset, and we credited, I believe it was cash. Okay. Didn't really matter what we credit right here. We're looking at how much supplies did we use. Then they tell us assume that dress right determines the end of July that there is $1,200 of supplies remain. Okay. What does that mean? Word. That means that's the ending balance. That's how much is left in the supply closet or the supply cabinet, wherever those supplies are. That's how much left. A lot of times we don't keep up. We have a cabinet in the faculty workroom that has paper stacked in there. Every time I go in there and I take a ream of that paper and put it in the copy machine, there's no journal entry made. Okay. They're going to go in there at the end of the year. They're going to count how much is left. They know how much they put in there. They know how much paper they bought. And then they can count how much paper is left. And then obviously everything else left the building, right? Okay, so if there's $1,200 of supplies left in that closet, that means we used up 800. Okay, So there's your credit. If you draw that T account out, there is half the entry right there. Okay. So you're going to credit supplies, the asset, and debit the supplies expense. Okay. Real quick, while we're right here, I want to draw the supplies account out again, and I'm going to put some words in there, okay? Because some of these problems are going to give you some of these other things. This one didn't give us a beginning balance, okay? But this is the T account with the words, not numbers. It's going to start with a debit balance. It's not ever going to start with the credit balance. If it did, somebody did adjusting wrong in the period before. Okay, this account does not typically switch to its opposite. Okay, any new supplies purchase will be debited. Okay, there will be an ending balance. Like I said, it's not going to ever switch over to a credit balance in supplies. Somebody did something wrong if they did. Okay. And then it's going to leave the supplies asset as supplies expense. Okay. So a lot of these problems, they could have said $1,200 of supplies were used. Okay. If they'd have told you that, that number's not right. Okay. But you see how we had to back into that number because they didn't tell us how much was used. They told us how much was left in there. Okay. All right. I know it took a lot more time on that supplies, but I think that'll help you later on. Okay. All right. So remember, I'm so glad they're giving us this information. So at the beginning of July, they had paid $24,000 to the landlord, representing 1 year's rent paid in advance. They divided that by 12 to get $2,000 per month. Okay. So that prepaid rent account, I'm going to draw it out. I know it's right over here. I'm going to draw it out again because this is another one that they can trick you on. Okay. And there would be a beginning balance. Any, I'm going to say, mm, new advances on rent. That's what I'm going to say, call that. And we would have an ending balance. Again, this is not an account that's typically going to switch over to a credit balance. There's something wrong if it did. Okay. And then it's going to leave that prepaid rent as rent expense. Okay. This is another one. They may not have even told you it's 12 months. They may have told you this much is in ending balance and that it represents what's unexpired, unused, or anything like that. So if they give you this number and they give you that number, you might have to back into what the rent expense is. Okay. But understanding those T accounts will help you a lot. All right. I told you we were going to have some depreciation. So office equipment was purchased during the month of July for 12,000. They said to assume the useful life is 5 years or 60 months, and it'll be worthless at the end of the period. So it's worth nothing, absolutely nothing. Okay. And they're going to divide that by 60. They've done that right down here to give us 200 a month. They're going to debit the depreciation expense. That is your income statement account. And we're going to credit accumulated depreciation. That goes to the balance sheet. Okay. That is the contra asset account. Okay. Remember, when you're doing adjusting entries, you're always going to have one income statement account, one balance sheet account every single time. Almost never cash. Okay, unless cash was messed up, that's about the only time you'll see an adjustment. Don't guess cash when you're doing adjusting entries because they usually don't involve cash. Okay, I'm going to jump past that one because we got lots of stuff to do. Here's an alternative to record the prepayments, Every now and then you might see this, so you just have to really read everything very carefully. So, on July 1st, Dress Right paid $24,000 cash in 1 year's rent on its building. The company could have debited the rent expense instead of the adjusting entry records the prepaid rent at the end. Okay, so they could have done that. So basically, they threw it all into the income statement. Okay, that's really wrong, right? So, and because we only have $2,000 of expense, okay, for the month of July, because that's going to cover the rest of the time. So the adjusting entry debits the prepaid rent. We're making this account go up and making rent expense go down. Okay. So you just sometimes draw those T accounts out and read every little word. Okay. All right, let's do the deferred revenue adjusting entry. So Dress Right Clothing Corporation subleased space to a jewelry store for $500 per month. And on July 16th, the jewelry store paid $1,000. We put it in this deferred rent revenue. That is your balance sheet account because that is the liability. Okay. We don't necessarily owe $1,000. We owe the rent, the service of that $1,000. And it was only for a half a month. So that ended up being $250 because they said 500 per month. If we divide that by two, at least they're not giving us difficult math to do here. Okay. So we're trying to get $250 out of this deferred rent revenue and then over to the income statement. Okay. A lot of students ask me, like, what triggers an adjusting entry? In this case right here, just the passage of time. That's why you have to have really good critical thinking skills because you have to just understand that $250, nothing really happened, but time passed from the middle of July to the end of July. Okay. Sometimes they will do this one a little bit different. Okay. They may have debited cash and put all of it in the revenue account. Okay. And then when they adjust it, they're going to move back to the deferred rent revenue, what hasn't been earned yet. Okay. Both approaches are perfectly fine as long as the adjusting entry is correct. Okay. All right. Let's look at accrued salaries. They told us on July 20th, Dress Right Clothing Corporation paid employees of $5,000 for salaries for the first half of the month. So on July the 20th, they paid the 5,000, and then we're going to assume that salaries for the second half of July are 5,500 and will be paid early August. Okay? So time passed from 7/20 to 7/31. Between there, 5,500 of salaries expense has to be accrued. Okay, so we're going to increase this salaries expense. That's your income statement account and credit the salaries payable. Then we're going to pay it later in August. Realize that salaries payable just holds it until it crosses that end of that period. Okay. Oh, I told you we had lots of stuff going on with that loan, right? So both of those loans had 10%. So that kind of made it a little bit easier for us to do 1 month's worth of interest. I know there was a lot going on. We could do both of those loans separate, but we would end up with the exact same number. Okay. But we had 40,000 as principal. 10% was the interest rate, and we're going to multiply that times 1 divided by 12 or 1/12. And we will debit interest expense, credit interest payable. This $333 represents a month's worth of interest. Okay. Let's just think about the fact if we did not make that entry. Okay. We would be giving an income statement that has $333 less expense on it. So revenues would be overstated. We would give them a balance sheet with a liability missing. Okay. That liability would be missing. So our liabilities are going to look a lot lower than what they really are. Okay. Our videos are getting long, so I'm trying to get through adjusting entries. Okay. So the alternative on that, we could assume that Dress Right loaned another corporation 30,000 at the beginning of August. Terms of the note call for payment of principal 30,000 and interest at 8%. This is where we loaned money out. We earned some interest revenue and we have an asset now coming to us in the coming months for that amount because we've earned it. Just because the cash hasn't come does not mean we have not earned it. Okay. Whew, we went through lots of adjusting entries and now we have an adjusted trial balance. Okay, so you can see we had all of these. Now look, we've got a whole bunch more accounts now than we did over here, but we have a more correct trial balance now than what we did. Okay, I will see y'all in the next video.